So you're thinking about the Aussie property market? Well, you better buckle up because right now it's sending some seriously mixed signals. Today, we're going to cut through all that noise, figure out what's really going on, and what it all means for you heading into 2026. Let's get right into it.
If you've been trying to keep up with the market, you are definitely not alone in feeling a bit confused. I mean, prices are just exploding in one city while they're basically flat in another. And interest rates, they feel crazy high. But are they? Really? It's a tricky landscape to navigate, whether you're buying, selling, or investing.
And this, right here, is the core of the puzzle. We're seeing completely different stories in our major cities. You've got Perth in the middle of this historic boom. Sydney seems to be catching its breath. And then there's Melbourne, the market that's been sort of asleep for years, but might just be the one to watch. So what on earth is going on?
To really understand what's happening, first we need to get our heads around a central idea that pretty much defines the current market, what experts are calling a two-speed market.
So what does that actually mean? Well, the idea is surprisingly simple. Right now, affordability is king. It's the single biggest driver. Cheaper properties are in way hotter demand and are growing in price much faster than the premium end of the market. And this isn't just a city versus country thing. It's happening in the very same postcodes, splitting the market right down the middle based on price.
And you can literally see this two-speed dynamic playing out every Saturday in places like Melbourne and Sydney. You know, auction clearance rates for homes over, say, $2 million have gone a bit soft. Meanwhile, properties under that $1 million mark, they're often getting snapped up before they even make it to auction. Understanding the split is absolutely the key to unlocking the whole story.
So, what's causing this split in the first place? Well, there are some pretty powerful economic and even psychological forces at play here, and they're shaping the decisions of millions of Australians. Let's break them down.
And this timeline just tells a huge story. We're talking about a massive interest rate shock. Think about it. For 13 years straight, a whole generation of borrowers just got used to an average cash rate of about 2%. The super fast jump to today's higher rates wasn't just a shock to the wallet. It was a psychological shock, forcing everyone to totally recalibrate what normal even looks like for borrowing money.
Now, that shock has created two major roadblocks for buyers. First, you've got the serviceability ceiling. You can think of this as a hard financial limit, a brick wall. Tighter bank rules and higher rates just mean people simply cannot borrow as much as they used to, period. And second is something called anchoring bias. This one is all in our heads. Because we were anchored to those super low rates for so long, today's rates just feel wrong, abnormally high, even if they're actually closer to what's been normal historically.
Okay, now here's where it gets even more interesting. These big picture drivers, they're affecting every city, right? But they're hitting markets that are all at completely different stages of their own property cycles.
This table just lays it all out in black and white. You've got Perth, which is just in the early days of a new growth phase, probably with years to run. Brisbane is in the late stages of a very long boom. Sydney is a bit more chilled out after that massive price run it had a few years back. And then you have Melbourne, the big outlier. It's been pretty much flat in real terms for a decade.
And that brings us right to this key insight from property strategist Stuart Wemyss. I mean, history shows us that long, flat periods in a market are usually followed by a growth phase. So after more than a decade of just treading water, the data is starting to suggest Melbourne's turn could finally be coming.
Okay, so let's zoom in. Let's put Melbourne under the microscope. Why are so many analysts now pointing to it as the market to watch in 2026?
This right here. This is the headline number that's really getting investors' attention. KPMG is forecasting that Melbourne's unit market is going to lead the entire nation's capitals in growth next year. And house prices aren't far behind. Now, that's a pretty bold prediction. So let's look at the evidence behind it.
I mean, wow, this chart really tells the whole story, doesn't it? While Perth and Sydney have seen these absolutely massive gains, Melbourne's growth has been, well, incredibly modest. And it's exactly this decade of underperformance that has so many people believing it's now undervalued and has the most room to grow.
And look, this isn't just wishful thinking. There are 4 really solid fundamentals that are driving this prediction. First, it's all about relative affordability. Melbourne is now way cheaper than Sydney. Second, there's a massive infrastructure boom happening. Third, strong population growth is just fueling constant housing demand. And fourth, the rental market is incredibly tight, which points to a serious shortage of places to live.
Okay, so the big picture from Melbourne looks promising. But if you're an investor, where do you actually start looking? And, just as important, what are the real-world challenges you've got to be aware of?
So the smart money isn't just buying anywhere. According to analysis from Innovate, serious investors are looking for a pretty specific checklist of things. They want suburbs with great transport, prices that make sense compared to local wages, big infrastructure spending happening nearby, and, this is critical, strong rental numbers to make sure the cash flow works.
And here are just a few examples of some suburbs that are ticking those boxes. Down in the affordable southeast, places like Cranbourne and Pakenham are offering strong rental yields, and they're going to benefit from that new metro tunnel. If you have a slightly higher budget, a middle ring suburb like Bayswater has seen some really impressive rental growth, around 11%, on top of its already established amenities.
But, and this is a really big but, finding the right property is only half the battle, especially if you're thinking about developing a property. Then you've got a whole other layer of complexity to deal with.
And this is just a crucial reality check for any would-be developer. That council approval process, it's a marathon, not a sprint. You've got that initial planning phase with all the paperwork, then the works phase, and finally the completion phase to get everything signed off. Each one of those steps can bring unexpected delays and costs, so being prepared is just, it's not negotiable.
All right, we have covered a lot of ground. After looking at all that data and analysis, what are the most important things you need to remember as we head into 2026? Let's bring it all together.
So let's just boil it all down to 4 key takeaways. Number 1, the two-speed market is real and affordability is driving the whole thing. 2, city cycles are everything. Perth is just not playing the same game as Melbourne. 3, Melbourne is the big outlier, and it looks like it's poised for a turnaround after a really flat decade. And 4, probably the most important one, do your homework. The small details, from which suburb you pick to how you handle council approvals, are absolutely critical.
So at the end of the day, the data points to some pretty clear trends and opportunities. But as we all know, the property market always has a few surprises up its sleeve. The real question is, armed with all of this information, how are you going to navigate these complexities and find value in the year ahead?